Hello, everyone. Here we are with another Bitcoin intelligence report. This week, we're going to follow up with what we said last week about the futures market holding the key. That was the section that we focused at very end part of the Onchain section. We were talking about why futures market was the main driver of the next move before price just go all the way to I think it went to 111. I think yes, it was sitting at 116, and 500, I believe, at the time. And then we were talking about even though the spot market was showing a little bit neutrality towards bullishness, the stage was ready for another wave of like liquidity coming from futures market side, because if you look at the long positions forming below 116, it was like a lot of open interest was being added to the futures market with the bias towards a price move to 120, 125. But unfortunately, the second scenario that we discussed here happened since then, and that was like market failing to absorbing the sell pressure that was happening at 116, and it broke below 116. And as we highlighted in that report, 116 was the max pain point for the long positions, and breaking below 116 would have triggered a cascade of long side liquidations, which adds and intensifies the move downwards, and that happened, and price went all the way to 111. Now we're going to talk about and start from this same topic. We're going to talk about futures market, and then we're going to use the cost basis of the people who or investors who started to accumulate after June, the peak we had in June, and we're going to explain why their cost basis can be used as a compass to speculate about short-term moves in the market. So let's start with the max pain. If you look at the long max pain point for the Bitcoin market, it's around 113 something. It's the almost 2000. If I say like around 1.27% below the current price, and the max pain for the short side of the high leverage perpetual positions is around 117. So as you can see, we are seeing the max pain have been dropping from 116 to 113. That's because of the recent price action. If we use the last 2 weeks, that we can get a better information, because it assumes the positions open over the last 2 weeks. The pressure point drops to 111, because it's assuming the last 2 weeks of changes in the perpetual markets positions. And if we look at the heat map, you can get a better picture of what happened after breaking below the 116, which was here. You could see the line, the 116 was broken, and then we saw a lot of long position get liquidated at every leg down. You could see, but after the Fed, I think Jerome Powell had in a speech yesterday, and price started to go up crazy. But as you can see, we are not seeing a lot of long position because the move was so sharp. The investors, the speculators, didn't get to build some positions during the price move up. But that 111, as you can see, is the maximum pain point for the long side of the high leverage positions in the perpetual market. Meaning, if price again get closer to 111, breaking below 111 can trigger another long side wave of long side liquidations that probably push the price towards the lower band of price models that we're going to discuss later in this article. So the bias, the positions that have been recently opened in the perpetual market is look like catching the falling knife. Like they are speculating, as you can see, even though we have been through a from 124 all the way to 111 something, we had almost a sharp crash, but people are still betting on the upward. And why we focus on the positions that are closer to the price spot price is because they are really, their liquidation price is really point is very close to the spot market, and they are the most sensitive positions that we have to be paying attention to. And at 111, there's still we can see a dense cluster of the long contracts, and I think since yesterday prices started to uh, enter another correction from 117, and this 111, if we lose this 111, we can see this long positions liquidation is going to trigger even further correction, possibly towards the lower band of the any price model you use for the short-term price speculation. So let's move into say why we believe this 111 cluster of long positions are pretty fragile. So if we look at the open interest since market hit 124 in mid-August, you could see the open interest is rising since then. And always when we are talking about open interest, most of the time, I try to use the BTC value of the open interest, because if you use the USD value, the price is affecting on the final value that you are estimating for the open interest. So you have to use the BTC to normalize the open interest by the price and see if there have been actually new positions being added to the futures market, or it's just been the nomination value changing with the price. So right now, in the BTC term, we see around 55,000 increase in the open interest in the futures market, and that been happening since price hitting 124. As you can see, that rise is having a divergence with the price, meaning the open interest have the speculators with the price dropping, they have been adding to their positions, which can resemble by the kind of dip or catching the falling knife, which is very expected from the futures market, especially high leverage investors side. They start to bet, okay, this is the bottom, and they get liquidated in every leg down. But right now you could see, while the open interest was going up, the funding rate across all assets, most of major assets, have been heating up as well. So they are reading or interpreting this leg down as a opportunity to buy the dip and get ready for the next move up. Given their cluster is very accumulated, is very close to the price. I mean, we're now at 115, but if you look at the baseline here, it's around 111.7. Given that concentrated cluster is on the long side, they're bidding on the upward. That means we are feeling more fragility on the long side of the futures market. Meaning, if price moves slightly towards 111, it can spook them. You might see another cascade of long side of perpetual markets start to get liquidated and adding to the sell side pressure. That's why we believe market is overestimating the momentum towards 120, 128, and any macro factor or any sell pressure in the spot market can trigger that sell-off in the perpetual market as well. So that's our reason. That's our interpretation of the futures market. But like yesterday, any macro event can change the dynamics, and you might see, well, we get some buy pressure in the spot market, especially ETFs, and the bias towards like strong, highly leveraged bias towards the move to 120, 128,000 actually win the game, and bulls win the game. But based on what we see over the weekend, we can see the fragility of the perpetual market, because they have been the main driver of the recent moves, is very, very concerning. Now, given that we are waiting for a spot market to see what they do coming week, we can use and focus actually on the top buyers, because if you look at their supply, because since early, or I think it was 11th of, yes, I think it was late June, early July, after that move to the new all-time high, you could see we are seeing the top buyers, or people who are speculating about another move, another leg up, they start to accumulate since then, and this supply is getting denser, and with price fluctuation range widening up, you could see this cluster is getting widened up. And as you can see with the move towards 124 in mid-August, bunch of these bottom buyers in early August, with price going to 112, 113, they start to accumulate, distribute. So they took some profit, and after price failing to hold 120 and start to crack towards 111, you could see some of them start to sell. So that tells you how sensitive the recent buyers are to the any sharp price move, either upward or downward. So we should focus on the recent buyers, specifically if we have the supply distribution heat map. We should specifically focus on the recently formed cluster of coins that been purchased or moved by the short-term holders. If we use the cost basis of this top buyers, we can build in a statistical model that can give us the extreme point, psychological point from the lens of these investors. Meaning, we can find what price would be their midline. If the market or spot price remain that midline, we can read the market and give it like a neutral score to the market. But if price moving towards the lower band, we can expect some sort of like sell-off or fear in the market. And if price is moving towards the upper band of this statistical model that been built based on the cost basis of this top buyers, can give us some sense of, okay, risk in the market is rising and rising. We should expect some sort of sell-off and like correction in the market. So using this specific cluster of or cohort of investors is going to give us a sharp lens to look at or speculate about the immediate move in the market. Now we can use the cost basis of this up to 2 months, because we are talking about the early July, late June, so it's almost 2 months, up to 2 month investors. If we use the cost basis, which is around 115.8 almost, and the one standard deviation above and below that cost basis, we can build a compass that is very helpful to speculate about the immediate move in the market. As you can see, since April, mid-April, price have been strongly lagging up and staying in the upper band of this price model. And we had a peak in May 2025 or early June. As you can see, that was hitting or getting close or touching the upper band of this price model. And since then, we stayed above this midline. We had two like very short pause, and we had like a little bit correction below this midline. And this is the almost second major one. Now we are fluctuating, moving around this middle line. That being said, as you can see, the momentum, if we take this midline as a reference line, the momentum of price around this midline is been weakening, and the time component of this weakness is in favor of bears. Even though we are close to the midline, given that we have been struggling with the upward momentum, and we had another almost 2 move towards the upper band, but we did fail to get close to 130, 128, we can say with some certainty that the momentum have been like almost losing. I think the momentum was lost early or mid-July. Since then, we have had like a long-term decline in the upward momentum, despite we had a move to new all-time high in 124 in mid-August. But the longer-term change in the momentum of these investors, price compared to the cost basis of these investors, have been negative. So the time component is not a friend of bulls here, given that the recent move is mostly driven by the futures market. Looks like we have more bias towards the further correction towards the lower band of this model, which is around 104. This lower band alongside the upper band must be measured every day because it's a dynamic formula. But around 104, 105, it seems like price is losing its momentum, and the patience or the time component of the bear is going to affect the psychology of the top buyers. If we fail to break above 116, after like almost a month, more than a month, that might cause some sort of panic, that might cause some sort of frustration among these top buyers, and that would add to the chance of further correction in short term. So using this model and given the fragile mm, nature of the cluster of long side position in the futures market, if you put this together, the chance of further correction is higher than the market finding its leg and moving towards 128 or 137. That being said, we have to watch the macro because both futures and spot market showing some sort of low liquidity. If you take the longer term rolling windows, not just yesterday, if you look at the last 2 weeks trend in the liquidity, you could see the 2% liquidity around the price is getting narrower, and that is a textbook definition of the low liquidity phase in the market. And given the weight of the futures market being slightly higher than spot market, especially in the recent move towards 117, we will see some fragility in the long side of the market, and we expect to see some sort of like correction. We might see some bounce back above 115, but we are seeing the macro similar to what we saw in Q1, Q2, 2025. From a longer term perspective, we see the momentum is towards downward, and we have to see what happens next week. Then we can update ourselves with this price model in coming report, probably next weekend. I hope you enjoyed this report. I tried to explain the charts a little bit faster than weeks before. If you have any question, please comment on Twitter, and the subscriber who have access to the Bitcoin Intelligence portal, you can leave a comment there, and I'll try to respond to any question you have about the futures market metrics and on-chain metrics. Have a good week, and see you next week.